The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon. This is Dave Clayman, CEO and Wealth Advisor here at 12 Points. Thanks for joining us for our special webinar today, the 12 Points Economic and Political Update with First Trust's Bob Stein. It is exactly 1 o'clock. It looks like we have about half the attendants have signed up. I'm going to give it just 2 more minutes for people to get on board, and then we'll get started. So thanks, everyone, and we'll be right back with you. All right, everyone. Thanks for your patience. It is 1:02 Eastern Time, and we are going to get started. So, again, my name is Dave Clayman. I am the CEO and co-founder of 12 Points, and we thank you for joining us here today for the 12 Points special webinar, Economic and Political Update with First Trust's Bob Stein. And we are very honored to have Bob here with us. Bob is spent several years in the Treasury Department and also was chief economist for the Senate Budget Committee. He analyzes potential changes to the direction of economic policy coming from Washington. He has a unique perspective on the political landscape, and he will look to provide us an in-depth look at the U.S. economy. So, Bob, thanks for joining us today.
Thank you very much for that introduction. So I will talk about the economy in a few minutes. Before I do that, I'm going to talk politics. Now, don't worry about what I just said. Okay, when I'm talking about politics, I do not talk about what I, Bob Stein, would personally like to see happen over the next few years. I'm only going to talk about what I think will happen instead, whether I like it or not. In terms of items on the policy agenda right now, we just saw Congress pass a bipartisan infrastructure plan that's touted as delivering up to about $1 trillion in extra infrastructure spending across the United States over the next decade. It's actually a little bit less than that. Some of this money would have been spent anyhow, but it will be extra spending on infrastructure to some extent over the next several years. So now we're moving on to a Democratic-only tax and spending plan, where earlier this year there was a budget resolution passed by both House and Senate calling for up to $3.5 trillion in extra spending. The open question is whether any of that extra spending will get done. Earlier this year, I had thought that there was about a 70% chance that this partisan spending and tax increase bill would eventually get to the president's desk. Given the result, the election results from last Tuesday, I think the odds of getting this extra spending and higher tax bill to the president's desk are only about 50%. Now, if it does make it there, I have some views on what the tax hikes would look like, and I'll be able to discuss them in a few minutes. But before we do that, let's talk about some other items on the agenda. In terms of the minimum wage, the left wing of the Democratic Party wants to see a $15 minimum wage, and they want to see it now. Well, they're not going to see $15 in my opinion, and they're certainly not going to see it now. What I expect is that in the first half of next year, there will be a bipartisan bill where the minimum wage would be increased to something on the order of $11 or $12 an hour. And it won't come in one fell swoop. Instead, it'll be phased in gradually over at least the next couple of years. So a higher minimum wage, but not nearly what the progressive left of the Democratic Party would like to see. In terms of trade conflict, we had a lot of trade conflicts between the Trump administration and foreign governments around the world, depending upon which country or group of countries President Trump was mad at when he woke up out of bed that morning. I think the policy approach to the Biden administration is going to be a little different. Simple rule of thumb. As long as a foreign government hires somebody from the Biden family, pays them very generous consulting fees, as long as the foreign government makes sure Hunter Biden's artwork is purchased for top dollar, there's not going to be a trade conflict with that foreign government and the Biden administration. However, there's one exception, and that's China. Okay. There was a 24-year period in the United States of a bipartisan nature, 8 years under Clinton, 8 years under Bush, 8 years under Obama, where the approach of the US government was to accommodate China, to basically bend over backwards for China on trade-related issues. Under President Trump, that period came to an end, and I expect that it will not reignite or go back to that 24-year accommodative era anytime soon. Whether we have a Republican or Democrat in office, the United States is going to be at loggerheads and have challenges with China as far as the eye can see, perhaps for the next generation, perhaps until all of us are dead and gone, frankly. So I do not see us going back to as easy a policy on China as we had before President Trump was in office. In terms of big tech, it's very simple. I expect lots of barking, but very little biting over the next few years under the Biden administration. When you look at where the political donations from big tech go, Amazon, Apple, Google, Microsoft, Facebook, many others, they are overwhelmingly in the direction of the Democratic Party. The Democratic Party is not led by fools or idiots. They are not in any significant way going to bite the hand that feeds them. Yes, there will be a slowdown in merger and acquisition activity in big tech. Okay, I consider that a little bite because we're going to see a slowdown in merger and acquisition activity across the board in the US economy, not only in big tech. In addition, although there may be some regulation on social media, the dirty little secret in Washington, D.C. is that many of the big companies in tech would like to see more regulation in social media because it makes it tougher for new entrants to enter that marketplace and get noticed. In terms of green regulation or environmental rules, I want you to think in terms of 3 buckets over the next few years. Bucket number 1, that's the bucket where the Biden administration is going to make changes and the Republicans have zero power to stop him. An example of that would be the automobile mileage fleet standards, the CAFE standards that regulate mileage standards for American cars and trucks. No power whatsoever to stop the Biden administration to raise those standards. Bucket number 2, these are changes the Biden administration has made and which Republicans have complained about, but really have not yet affected the energy market in any significant way. An example of that is slowing down the process of new leases on federal land to drill and extract fossil fuels. It is true that the Biden administration has slowed this process down and that energy prices are up significantly this year, but that's more of a coincidence than anything else. Over the past couple of years, before the Biden administration came in January, the Trump administration was giving away these leases like they were going out of style in 2019 and 2020. So even though the Biden administration has changed policy and the Republicans complain about it, it really hasn't affected the price of energy much, if at all. Yes, the price of energy is up. It would have been up regardless of whether President Trump stayed in office or not. Bucket number 3, and this is a little more difficult to follow, so please bear with me for a second. Bucket number 3 are things that the Biden administration is going to do, where they're going to ramp up rules and regulations, but which I believe many of those rules and regulations are going to end up getting struck down by the federal courts in 2023 or 2024. An example of this is making it issuing rules and regulations that make it more difficult for utilities to burn fossil fuel in order to generate electricity, or making it more difficult for drillers and extractors of fossil fuels, not just on federal land, but across the entire United States. So we saw an element of that recently with some new rules regarding methane emissions. Here's the deal. Whether we like these rules or regulations or whether we do not, I have to tell you what I think is going to happen. I think there'll be a ramp up in regulation, but many of those rules will be struck down by the courts. I believe there's now a majority in the Supreme Court to revisit and overrule something called the Chevron decision from the mid-1980s. Chevron, think of the oil company Chevron. Basically, the Chevron decision from the mid-1980s said that when federal regulators come out with new rules, that the courts are going to have a light touch. They're going to very lightly scrutinize those rules. They're basically going to assume that the regulators knew what they were doing and knew how to interpret their legal mandate. I believe if they overturn the Chevron decision, they may replace it with the courts may replace it with a much tougher level of scrutiny. And that level of scrutiny could be something like this. When regulators issue rules, if they're challenged in court by other parties, the regulators are going to have to point to specifically where Congress has passed a law allowing those particular regulators to issue that specific regulation. It's a much tougher level of scrutiny. And if the federal courts, or the Supreme Court in particular, goes in that direction, many of the rules and regulations coming out from the Biden administration in that area will eventually be struck down. In terms of taxes, I want to start with the most important point. I believe there's only a 50% chance that a tax hike bill, part of Build Back Better, the Biden administration's program, that a tax hike bill makes it to the president's desk. In other words, I think there's a 50% chance that we see zero tax hikes at all. Now, if a bill gets to the president's desk, what is it going to look like? First things first, I think there'll be no retroactivity in terms of the tax hike. There may be elements of the tax bill that are retroactive, like the state and local tax deduction, but I don't think any part of the tax hike will be retroactive to this year. I think they'd all be effective January 1st of next year. In terms of the top personal tax rate, right now the top rate is 37%, which is where it was lowered to from 39.6 under President Trump. There's some talk of raising the top rate to 45% for people making, say, 25 million a year plus. I think in the end, if there's a tax hike, we're going to end up with a top tax rate of around 39.6%. Now, 39.6% should ring a bell. It's exactly where we were for 8 years under Bill Clinton, for the last 4 years under President Obama, and for the first year under President Trump. And those 13 years all have something in common. There was a bull market in stocks and not one recession during any of those 13 years. So whether you like 39.6% or not, compared to where we are today with 37%, the one thing we know for sure is that just because you go back to 39.6% doesn't mean you go back into a recession automatically, or even close. Now, I'm not saying there's magic surrounding 39.6%. You could have a recession at 39.6%, but other things would have to go wrong. Simply raising the top tax rate to 39.6% does not cause a recession. Now, in terms of the corporate rate, we had 35% for a generation before President Trump took office. He cut it to 21%. I think we're going to end up somewhere in the vicinity, if they pass a tax hike at all, somewhere between 21 and 25%. The way I look at this is a glass half full. I don't think anybody in the United States thought that once we cut the corporate rate to 21%, that it was going to stay at 21% forever. I don't think 21% forever was ever priced into the market. And so I don't think it's going to really hurt equity prices to any significant extent to raise it to 25% instead. In terms of the SALT cap, the state and local tax deduction, it was essentially unlimited before President Trump took office. They put a cap on it under President Trump to $10,000. I think in the end, that $10,000 cap goes to $20,000 instead, maybe a little more than that. Some people are talking about $70,000 or $80,000. I think in the end it'll go up but not as substantially as that. In terms of the capital gains and dividend tax rates, the Biden administration proposed raising those rates to 39.6% for the top earners. I don't think that's going to happen. Right now, the top tax rate for dividends and capital gains for the highest earners is 20%. Plus, you have an extra 3.8% due to Obamacare, the Medicare tax. So that makes it essentially about 24%. What I think will happen if they raise the capital gains and dividend rates is to make that 24%. So you total it all in and you end up in the vicinity of 28%. That is exactly where the top tax rate was on the highest earners for capital gains and dividends when President Reagan left office early in 1989. So I think in the end, it's very difficult for Republicans to complain about a tax rate that existed when President Reagan left office, Mr. Tax Cut himself. The Biden administration has also asked to eliminate the step-up basis of death. The step-up basis basically means that if you inherit stock worth $100,000 and it goes up to $150,000 after you inherit it, that if you sell it at 150, you only have to pay a capital gains tax on the 50,000 gain that occurred when you own that asset. Okay. You do not have to pay any tax on the increase in value before you inherited that asset. Okay. However, the step-up basis of death has been the law of the land for 100 years. And because of that, I don't think it's going away. I think it would be an administrative nightmare to eliminate the step-up basis of death. Many people have no idea what their parents or grandparents originally paid for an asset. So what I expect instead is a reduced estate tax exemption. The estate tax exemption was about $5.5 million pre-Trump. Now it's about $11.5 million. I think it goes back down to something like $6 or $7 million instead. So lower than it is today, but a little bit higher than it was before President Trump took office. So that would hit a lot of the same people who would be affected by eliminating the step-up basis of death without the administrative rigmarole or nightmare that would be caused by eliminating that step-up basis of death. In terms of looking forward politically, here's what I think is going on. I think in the midterm elections, the Republicans have a 95% chance of taking the House, a 65% chance of taking the US Senate next year. They're favored in both, but much more so in the House than the Senate. Okay. The Democrats already have very thin majorities in both the House and Senate, and the Senate is essentially tied. They only have a majority, the Democrats do, because Kamala Harris, as vice president, can break the tie in certain circumstances. On the House side, the Republicans only have to gain about 5 seats to take a majority. If you look at the history in midterm elections, the party that does not control the White House, this time the Republicans, do very well in midterm election cycles. Republicans also did well in 2020 in state legislative races around the country, even though they lost the White House. And because of that, they hold the pen on drawing many of the district lines that are being drawn due to redistricting after the census every 10 years. In addition, when you look back at Tuesday of last week, the Virginia governor's race tends to be a harbinger of what's going to happen in midterm election cycles. 4 years ago, the Republicans lost the Virginia governor's race by 9 points. This year, they won it by 2 points. That's an 11-point swing. If there is a similar 11-point swing in midterm election cycles, and usually the midterm election change from one party to another tends to mirror what happened in the Virginia governor's race, then the Republicans would almost certainly gain a large majority in the US House. In addition, if you look at state legislative races around the country, actually not around the country, but in Virginia and New Jersey last week, the Republicans did consistently about 6 or 7 percentage points better in state legislative races than they would have done in a more neutral political year if the races had happened without a Republican advantage based on the demographics of those districts. And so that is also a sign that the Republicans should do well in the midterm election cycle. Now, here's the difference. Why is it 95% in the House and 65% in the Senate? Shouldn't those two numbers be closer together? Here's the deal. There are 435 members of the House. Every single one of those seats is up for grabs next year. In the US Senate, there are only 100 senators. They have 6-year terms. Because of that, next year there are only 34 Senate races. Well, here's the deal. Of those 34 Senate races, 20 of those races already have a Republican incumbent. And if you already have a Republican incumbent, you have to defend those seats. You can't gain those seats. So the Republicans can't gain any from the 20 they already occupy. There are only 14 seats that have to be defended by the Democrats. 14 of the 100, rather than all 435 up for grabs in the House, with the majority being Democrat. Because of that, I give heavier odds to the Republicans taking the House than the US Senate. One additional problem I see for the Republicans next year is what I call the Christine O'Donnell problem. Okay, back in 2010, newly elected President Obama has to go through his first midterm election cycle. The Republicans were really excited about picking up so many seats, and because of that, in some states around the country, you had candidates coming out of the woodwork for the Republicans. Christine O'Donnell came out of the woodwork in the state of Delaware, a political novice, and she was able to get the nomination instead of somebody who had served in the House for the Republicans for multiple decades. Christine O'Donnell went on to lose that race. In other words, sometimes prospects look so good for your party that you get fringe candidates coming out of the woodwork who can get your party's nomination and then squander the possibility of winning in the general election. So in the end, 95% for taking the House, but only 65% for the US Senate. In terms of the presidential race coming up 2 years later, let's just take a quick view of that. On the Democratic side, it's pretty easy to figure out what's going on. If Joe Biden wants to run for re-election, he would be the nominee of the Democratic Party. My guess is he will probably not run for re-election. And if he doesn't run, Kamala Harris would be the natural heir. I do not see any normal politician like Elizabeth Warren, like Pete Buttigieg, challenging her and taking the nomination away. However, I do see a possibility of a wild card, somebody who's never run for office, somebody who can easily self-finance a campaign, someone who can speak extemporaneously about politics without sounding like a politician, someone who would appeal to people in the suburbs, and someone who I believe would satisfy the American public's urge to see an accomplished celebrity in office. Not somebody who's famous for being famous like the Kardashians, but someone who's actually accomplished something significant. The person I'm thinking about is Mark Cuban, the billionaire entrepreneur, the Shark Tank, one of the Shark Tank hosts. I believe he covets the presidency. I don't know whether he would run in 2024. He certainly would not run directly against Biden. But if Biden chooses not to run, I could see him potentially throwing his hat in the ring. And if he did, I think he'd be a formidable challenger. On the Republican side, we have absolute chaos. I came up with this list earlier this year, just off the top of my head, trying to list people who might decide to run or not. In the end, I think it's fairly straightforward. If President Trump decides to run, and frankly, at this point, I have no idea whether he will. If President Trump decides to run, he'll probably be the nominee for the Republican Party. If he decides not to run, I don't think Trump Jr. decides to run. I think Ron DeSantis would become the favorite. And if he got the nomination, he would probably pick Nikki Haley, the former South Carolina governor, as his running mate. And if so, I think that'd be a very formidable challenge, a very formidable ticket for the Republican Party. In terms of the US economy, my theme for this slide, at least the upper part of this slide, is glass half full, glass half empty. Very straightforward, and I need you to remember that. Economic growth for this year, we're estimating at 4.5%. I think next year will be another solid year as well, although not as quickly. Here's the deal with 4.5%. It's the fastest economic growth for any year since the late 1990s. So that's obviously the part that's glass half full. Here's the part that's glass half empty. Even with 4.5% economic growth this year, the US economy is still going to be smaller than it would have been if COVID had never hit the US. So we're growing quickly, but we're still behind par. In terms of job growth, I expect for this full year, we're going to see 600,000 jobs per month. That means it's adding 7.2 million jobs total. Here's the deal. That's the fastest job growth ever in the United States for any calendar year. However, at the end of this year, even if we get 7.2 million jobs this year, we're still going to have fewer jobs than we did pre-COVID in February of 2020. The unemployment rate, I think, will end up right around 4.5%. I think it's 4.6% for last month. I think we end up at 4.5% for the end of this year, probably around 3.5% by the end of next year. Inflation, I expect around 5.5% for this year. I do agree with the Fed that inflation will be slower next year, but the Fed thinks it's going down to around 2.5%. I don't think we're getting anywhere close. I think it's going to be more like 3.5% plus. 4% we could easily do. Despite that, I expect no change in interest rates next year. I'm sorry, no change in interest rates this year, and maybe only one next year, despite high inflation. Here's the deal. A lot of people are thinking that because the market is priced in 2 or 3 interest rate increases next year, it has to happen. But I don't see it that way at all. When I look at the personnel changes at the Federal Reserve, they are shifting in a more dovish direction. We already have 2 bank presidents that have to be replaced, Rosengren in Boston, Kaplan in Dallas. We have Randy Quarles, the head of regulatory supervision, who just announced he's leaving the Fed at the end of the year. He's a Trump appointee, probably fairly hawkish. Richard Clarida, with whom I worked at the Treasury Department many years ago, he's the vice chairman of the Fed. His term runs out at the end of January of next year. He's probably going to be gone. In addition, there's another vacancy at the Fed on the board of governors, and President Biden still has to decide who will be the leader of the Fed sometime starting early next year. When I look at all of those facts and the change in the personnel and factor in that the Biden administration is going to lean heavily towards appointing dovish policymakers, I think there'll be one interest rate hike at most next year. In terms of the long-term yields, I think 1.5% at the end of this year, maybe 2% at the end of next year. Now, there are a couple more things I'd like to talk about. One is the budget deficit. A lot of people are worried that the US is on the way to becoming the Argentina of the 21st century, that our debt's too high, our deficits are too high, and eventually we're going to be bankrupt, unable to pay our bills. Here's the deal. I like to measure the manageability of the federal debt by looking at interest costs relative to GDP. Same way as I look at personal finance. If you look at a homeowner, you want to know what their mortgage payment is relative to their income. Okay, if it's too high, then you're in trouble. If it's too low, maybe you have room to lever up a little bit. So I like to look at interest relative to GDP. Back in the 80s and 90s, the interest cost of the federal debt was regularly 3% of GDP. Right now, 1.6% of GDP. Now, I know what you're thinking. Interest rates are going to be up over the next few years. So what's going to happen there? Let's imagine a scenario, though, where interest rates double tomorrow. Not just go up a little bit, double tomorrow. So interest rates on the short end are still near 0%, but on the long end, they're close to 3%. So on average, the interest on newly issued debt would be about 1.5%, somewhere between 0 and 3%. Okay. At 1.5% interest rates, even if interest rates double, the interest rate on newly issued debt would still be lower in most circumstances than the interest that we're rolling over. Remember, we have securities that are outstanding where we have 30-year debt from the 1990s still. We have 10-year debt from a decade ago, 5 years ago, when interest rates were generally higher. So even though interest rates are likely to go up over the next several years, even if they double tomorrow, even if they double over the next few years, the average interest rate on newly minted debt is still going to be lower than the average rate on the debt we're retiring. And so this is not going to skyrocket anytime soon. Other people say, okay, I'm comparing interest to GDP. I should be comparing interest to federal revenue. But when you do that, this is interest relative to GDP. Here's interest relative to federal revenue. Okay, it's pretty much the same darn chart. The same pattern prevails. So the same argument applies to interest relative to federal revenue, that applies to interest relative to GDP. One more way of looking at this, American households combined have 160 trillion, with a T, trillion dollars in assets, okay? It's never been higher. We have combined about $17 trillion in personal debts. These are mortgages, student loans, automobile loans, other types of loans as well at a personal level. If you take out that money, we're left with 143 trillion in net worth, our assets minus our debts. We then take out the national debt, which is roughly 28 trillion. We are left with 115 trillion dollars. Okay, think about what I just said. Take all Americans' assets combined, stocks, bonds, businesses, real estate, everything. Take out our personal debts, take out the national debt. What do we have left? $115 trillion. That number has never been higher. It's 5 times GDP. That ratio has never been higher. So I'm not going to tell you the debt is good. I don't believe that. The debt is bad. Okay, but just because something's bad for you doesn't mean it's going to kill us tomorrow. And that applies to the national debt. David, I'd be happy to stick around and answer any questions people might have.
Yeah, so a couple of questions here so far. Thank you for that, Bob. One I saw here was, so real GDP, just to be clear, real GDP is including inflation, ex-inflation? Because we saw the numbers, and I'm guessing it's not including inflation.
Great question. Real GDP does not include inflation.
Okay.
So including inflation would make it something called nominal GDP, okay, which this year would be up around 9.5%, because we're running around 5% inflation for GDP prices, which are a little different than consumer prices.
Okay, great. And then another question. So obviously the Fed started the tapering process here last week. Any consideration on the effect that might have on interest rates, or does it appears that First Trust view is that won't have a significant impact on interest rates?
That's correct, David. We don't believe it'll have a significant effect. You have to remember that this tapering of quantitative easing was widely telegraphed over a long period of time. Everybody knew it was coming. And if you know something is coming, it's already priced into interest rates and equities. In addition, they're not going to change short-term interest rates themselves until tapering is done. That's likely to, I think it'll proceed along the pace that the Fed has said, and will be done probably by the middle of next year, at which point quantitative easing stops and the balance sheet of the Fed no longer grows.
Great. And then lastly, on the inflation front, you mentioned that you don't share the Fed's view, or excuse me, First Trust does not share the Fed's view on it being quite as transitory as they've projected. And yet, certainly the 10-year running at a top rate of 2% next year with 4+% inflation is a little surprising. Any comments?
Yeah, sometimes the economy doesn't make sense. Just because inflation's running hot and GDP is running hot doesn't mean you have to have higher long-term interest rates. I mean, we've witnessed that over the last year and a half, where you've had a robust recovery from the COVID disaster, higher inflation, and today the long-term interest rate is 1.5% in the 10-year. So we're thinking that long-term interest rates move up, but not as quickly as many other people do. Here's the problem with their forecast. They're anticipating that the Fed's really going to move 2 or 3 times next year for short-term interest rates. We only think they're going to move once. And so if the Fed moves less next year on short-term rates than the market anticipates, what should happen to long-term rates? Well, there's room for them to go down a little bit. Now, we think there'll be offsetting factors to that phenomenon, which is that economic growth will continue at a fairly robust rate, although not as quickly as this year. And we think inflation will exceed what the market anticipates. So I know this sounds odd, okay? we're projecting higher inflation than the market anticipates, but fewer rate hikes than the market anticipates. In other words, we anticipate the Fed being less responsive to inflation than the market thinks it will be. And we think that's due to the change in personnel, as I mentioned earlier. Remember, things in economics don't always work where everything moves in the same direction like it should. Often certain things move in one direction and other things move in the other. We think this is one of those cases.
Just amazing to see people willing to accept a 2% 10-year in a 4+% inflation environment. But we've seen it for now. We'll see if it lasts.
Yep.
All right. Well, I think that's all the questions we have for today. I don't see any more rolling in. Bob, we really appreciate you joining us today. It was a pleasure to have someone with your experience to educate our people, and we appreciate it. So everyone, thank you as well for your time. We hope you found this valuable, and we look forward to hosting you on our next webinar. Thanks very much, everyone.
Thank you.